class, in the present session, we'll discuss about the tax treatment on pension. So, if you have a pension, there will be no tension at the time of retirement. So, many people will be working after working for so many years or so many days. What happens? We'll retire from the service. Once we retire from service, what are the tax implications, or what are the uh, procedures for taxing, or what are the procedure when we pay, or when first of all when we receive the pension from the employer. So employer will be working in any organization, in many organization will be working. Once we retire from the organization, so what this pension we receive, so in the hands of pension received person, it means that pension, the person who is received, or person who is called as uh, assessee, who receive the pension. So what is the tax treatment in his assessee's point of view? So whether this pension is taxable or not, so that we are supposed to discuss, we'll discuss today. So normally it will be, when we receive a pension, as per India, as per Indian Income Tax Act, Indian Income Tax Act 1961, section 10 subsection 10. So under section 10 subsection 10a, so this explains regarding the tax provisions on pension. So how much amount is taxable and how much amount is exempted as per the income tax provisions. There are many rules, regulation under this Income Tax Act. So this Income Tax Act is a huge act which has more than 600 sections in it. And as per this section 10, subsection 10, how much amount is taxable in the hands of employee? It means once he retired from the service, how much amount is taxable, how much amount he is supposed to pay tax, and remaining how much amount he is supposed to not to pay tax. So that we'll discuss one by one. First of all, the meaning of pension. And here, pension, the meaning of pension: pension means a periodical payment received by the employee. So amount which is paid by the employer for the, for considering the service of employee in the organization. So the pension sometimes, there are two kinds of pension funds. So pension, if we are working as an employee, pension. So for example, normally if I'm working in ABC company and I retired after 60 years, or I'll retire from the service. Once I retire, this company, ABC company, will be paying pension to me. So this is one kind of pension where employer will pay pension. And another, so I'm a normal citizen, or Mr. X is a normal citizen. He has fund and he is doing business, and for his for his retirement, it means once he attain the age of 60 or 70 in his old age, he needs some financial backup, or he needs some financial plan for his expenses. For that, what he'll do, he'll deposit from some amount in the bank, he'll deposit some amount in the bank or pension fund schemes. There are different pension fund schemes. He'll deposit that money in this bank, and once he attain the age of 60, he'll be getting pension. Or once he attain the age of limited or fixed years, he'll be getting a pension from the bank. So this, there are two kinds of pension. One is employer pension, and it means that is normally called as employment pension, or a general pension scheme. So for the general pension scheme, we have different pension schemes like Atal pension scheme, Atal Pension Yojana, that is central government's plan, and also we have NPS, new pension scheme, and national pension schemes. There are different these kind of pension schemes which are also not part of employment pension schemes. And mainly when it comes to employment pension schemes, here pension is a periodical payment received by the employee. Employee is going to receive from employer. So here employer will make payment for you. So for the service of, for employer will pay the pension. You are working in a company, and once you retire from the service, and this employer will pay money after the retirement every month. It means your salary, for example, before the retirement, your salary may be for 25,000 example, and to compensate you, to maintain all your day-to-day expenses, all your necessities after once you retire from the service, your employer may give 5,000. This is a simple example, 5,000 or 6,000 for your daily requirements or daily necessities. This amount is called as pension. And so there are tax implications, there are tax policies as per section 10, as per this section 10 subsection 10A of Income Tax Act. Pension is fully taxable. The amount what we receive as a pension is fully taxable in the hands of employees. If you are an employee, you are supposed to pay tax on the amount what you receive from the employer. It means as an employee, I'm working in one organization. I retire after the age of, or after certain years working there, I'll retire from the service. Once I retire, the entire amount should be taxable here. It may be a, I may be a government employee or non-government employee. In both government and non-government cases, non-government employee cases, I'm supposed to pay tax in the hands of my. It means I need to pay tax on the pension what I receive from the employer. And here same what I explained, I'm working in one organization, I'll be receiving salary for my working till my age, retirement age. Once I retire from the service, what I'll do, company will pay very minimum amount. It means monthly I'll get the, earlier I used to get the salary of 25,000. Now I may get the I may get the pension of rupees, uh, will make, let it be 5,000. So now what I'll do, I'll get only 5,000 rupees for all my expenses. So this 5,000 rupees pension. And here pension, there are two kinds of categories in the pension. Again, in hands of individual, it means I supposed to pay tax. I supposed to pay tax to government, tax to government. So if I'm a government employee or non-government employee, in both cases, government or non-government, in both cases I'm supposed to pay tax on this pension what I receive here. On this amount I'm supposed to pay tax to government. Then, so here types of pension what we receive. So there are different kinds of pension here. One is uncommuted pension and commuted pension. So uncommuted pension is a periodic payment made after the retirement the employees. It means normally what I'll do, just one example. I'm working in one organization. In the just previous slide, I explained that I was getting 5,000 rupees as a pension. So here this normal amount, how much the company decides, that amount, that entire amount is considered as uncommuted pension. I'm working in one organization, I retire from the service, and the company decides to, that organization decides to me give 5,000 rupees as a pension. That 5,000 rupee is an uncommuted pension. It's a periodic payment, normal. There is no any deduction in that, directly employer will pay. And commuted pension, sometimes employees, as an employee what I do, I want a lump sum amount. I want a lump sum amount. So for this lump sum amount what I'll do, I'll contribute certain amount and I'll take the lump sum amount. So for example, I retired from the service in the month of January. In the month of January I retired from the service, and till March, till March I was receiving 5,000 rupees, and after that I need lump sum amount, I need huge money. What I'll do, I'll commute in the sense means surrendering or contributing my pension to them and taking the lump sum amount. What I'll do, I'll contribute this, out of this 5,000 I'll contribute 50%. I'll give 50% to them, and I'll take uh, for example 60,000. 60,000 rupee, I'll take 60,000 rupee and I'll contribute 50% of it. It means 50% of it. What? How much will come? 50% of it in the sense, for example, 50,000. If I contribute, if I commute 50% of it in the sense, I'll get only 2,500 pension. Earlier, I was getting Earlier, in the earlier case, I was getting 5,000 rupees as a pension. When I commute, it means when I surrender my remaining pension. So now this 50% I'll contribute, I'll give to them, and I'll take 60,000 rupees lump sum amount. When I take this lump sum 60,000 rupees, so that how much part I commuted, only that part will be considered for this 60,000 and remaining will be paid as commuted pension to me. It means earlier I was getting 5,000 rupees. By giving 50% to them, I got 60,000 in cash. 60,000 rupees cash. Immediately I'll receive the cash 60,000, and remaining month lifelong I will be getting only 2,500 rupees as a pension. So here what is the difference? Normal uncommuted pension was 5,000 rupees. After that, when I commute, when I surrender my remaining pension amount to them, the remaining, how much it was remaining out of 50% if I deduct it, so that much will be the commuted pension. So in these two examples, commuted pension is 5,000 and uncommuted pension is 5,000 and commuted pension is 2,500. And this is the tax treatment for commuted pension and uncommuted pension. So first we'll discuss regarding the uncommuted pension. Uncommuted pension, it is fully taxable in the hands of both government and non-government. So here in this case there is no much confusion, there is no much uh, confusion, and there is no much complication in this calculation of tax on uncommuted pension. Directly entire amount is fully taxable if even you are a government employee or non-government employee. But when it comes to the commuted pension, uncommuted, there is no any confusion, there is no any complication in calculating directly amount what they receive. The tax, as per the tax rates, tax will be calculated. But when it comes to the commuted pension, here again the commuted pension is further classified into two. Commuted pension is classified into two. One is government employee and non-government employee. So here government employee, it is fully exempted, and for non-government employees, see here, for non-government employee, partly taxable, partly exempted. So if you are a non-government employee, you comes under this. If you are a government employee, you don't need to pay tax. And for non-government employee, again it is further classified into two category. So one is if you receives gratuity, and if you does not receive gratuity. While during the time of retirement, if you during the time of retirement, if you receives gratuity, so there is one calculation, it means one system, so one method where you are supposed to follow that procedure. And if you are not receiving the gratuity at the time of retirement, so then you are supposed to follow one more method. Again it is further classified into two ways. We will discuss one by one. Here, tax treatment for commuted pension received by the government. See, is for government employee, if it is a commuted pension, it is fully exempted from tax. No need to pay tax here. No need to pay tax here, exempted. Then for government employees, the government employee may include central government or state government employee or local authority or any statutory organization or statutory corporation as per uh, Companies Act, any statutory provisions, it means statutory corporation like LIC, RBI, SEBI, all are statutory corporations, and also public sector undertaking, even public sector undertaking banks, so which are directly comes under the government's control. So all these organizations are called as government organizations or government employees, or who employees who are working in these organizations are called as government employees. Then for non-government again, as I mentioned in the earlier previous slide, again there are further classifications are made. Here for the classification, employees receives gratuity. If he receives gratuity, this is the procedure. If he does not receive the gratuity, then this is the procedure. So one amount will be given, for example 60,000. Then least of the following. So which amount out of these two, which amount is the very minimum, very least? It means that which or that value will be called as exempted amount. So here also same thing, one amount will, 2 points are given here. One is actual amount received, it means actual commuted pension he receives. Then this formula is very much important here. One third, same. When we compare these two, both are same except this point, except this uh, here. See here, this one third should be half. I'll make some changes here. This is 1 by 2. While typing, I made a mistake. That is not one third, it is half, 1 by 2. And here, compared to this two, both are same. Actual commuted pension received, this is same. And here also actual commuted pension received. And only here, this part, here the formula is one third. If you receives gratuity, see here, if you receives gratuity, so this formula. And if you does not receives gratuity, this formula. Both everything is same. If you receives gratuity, the formula is 1 by 3 of pension what you receive. If you does not receive gratuity, the formula will be 1 by 2 half. This is the format is the employee. This is for commuted pension, for commutation of commuted pension, and this is the format for computation of taxable pension. And if he receives gratuity, receiving the gratuity, and here 1 by 3, same as usual, actual pension received. Out of this amount, we are going to deduct 2 points. One is, first point is actual pension received, so same will come here, actual commuted pension. Then 1 by third, 1 divided by 3, it means how much commuted value. For example, here it is 1 lakh. 1 lakh is the commuted pension, so 1 lakh into 1 by 3, then amount will be 33,333, 1 by 3. So this much will be the second point, and first point depends upon the question. This is the example. Then here for the employee who does not receive the gratuity, for example, you have not received the gratuity, then what will be the tax implication on the pension what you receive as a commuted pension? So here, same as I mentioned earlier, actual amount of gratuity received. So actual amount of gratuity received will be the first point here, same, both are same. Then the second point is half. Second point is half. So same. So this is second part is half. In the previous stage it was 1 by 3. Here it is half, 1 by 2. And for example, same. I'll give the same 1 lakh example. 1 lakh rupee into 1 by 2. 50,000 will be the amount here. Out of this two. Out of this two, which will be the very minimum, out of these two, which will be very minimum, that amount will be, should be written here, then should be deducted from the actual amount received here. This is a procedure, and this is a format for calculating the or computing the taxable pension as per the government, as per the section, as per the section 10 subsection 10A of Income Tax Act of 1961.